Well, welcome back to school. No, it's not the fire alarm. It's a bell that used to ring when you go back into class. Of course, September is upon us. And in the Northern Hemisphere, summer is drawing to a close. That means it's back to school time and back to business in the corporate world. But it's not exactly been a quiet August. US equities have marked their longest bull run in history, with the Dow, Nasdaq and S&P continuing to break new record highs, and extraordinary moves for some of these indices, including the fact that, as I just mentioned, in the month of August, we saw the technology subsector alone up 6.7%. And I know we're going to get into a good bull-bear argument in a moment, and it's well-tried and tested arguments on both sides. You can make a very convincing case. But I'm just going to give one early stat here. For those of us who are sceptical about valuations in the US, we're very concerned about where we've come from. There is one big check that stops us and holds us back every time from actually being really convinced by our argument, because I am a natural skeptic. I can't help it. And the thing that holds me back is the fact that the US earnings in the second quarter were once again 20-odd% high. They were exactly 23.5% high. Now that wasn't an outlier. That comes on the back of the first quarter, where it was pretty much the same kind of figures, and expectations of the same kind of figures in Q3 and Q4 as well. So for those of us who look at these sky-high 2,900 S&Ps and 26,000 plus Dow, and concerns about a Nasdaq scooting through 8,000, the caveat for us is the fact that earnings remain so very, very strong.
And that's the challenge, isn't it? That while you've got peak earnings and you've got peak margins, for other markets, they're just not participating. It's been a very different story for commodities. The bulls have not been taking a shine to gold or crude prices. Both of these represented over my shoulder on our swings here, as we try and show you just how poor the environment has been for commodities in this recent phase for the market. So June and July, better. We've come out of that phase, though, and we are not seeing any resilience at all, really. Well, I say not seeing any. A little bit on the days where the dollar gets a little weaker, but if you watch the dollar index, it's largely acted as a lodestar to understand what is going on in the broader commodity complex. One point just to make, though, I think about oil, where gold hasn't necessarily reacted to geopolitical issues, oil, I think, has been a bit more sensitive to that. And as we continue to look at the train wreck, which is the Venezuelan economy, and we try to figure out what is happening to Iran and in terms of sanctions from the United States, I think that is giving a little bit of a bid to the oil price, which is holding it firm around this $70 a barrel level.
You've been somewhat of an average student if you look at the performance in your basket versus the teacher's pet over there.
Story of my life, Karen.
I'm in detention camp for the first time over here. Let me take you to where the pain has been felt in emerging markets. A political crisis in Turkey began to bleed into the currency markets, while Argentina has battled to get the peso stabilized amid crisis talks with the IMF. But it's not just the peso. It's been the rand that's been under pressure, the lira we've been talking about, the crisis in Turkey, and whether that was a bellwether or the canary in the coal mine for many markets. But it's also stretched to strong economies where you've had growth of about 7-odd%. The Indian rupiah has been under pressure. The Indonesian currency has faced a big drop. In fact, it's right back to some of the lows that it's not faced since a financial crisis about 2 decades ago. So it's telling you there is a shakedown in emerging markets. And again, do we go back to the Fed? Is it right back to the US market, where you've got withdrawal of stimulus, extraordinary withdrawal from monetary policy, and that's impacting these markets? It doesn't matter what the accounts look like. It's every excuse under the sun, from the fiscal accounts to governments to policies to elections to institutions, how they're being run in these countries. I don't see these markets turning around anytime soon, despite the fact many think we're at really peak anti-EM sentiment.
Here, and we've got a guest coming up on this in a moment. Look, just one or two other points. I mean, you just alluded to the Federal Reserve, and a lot of these countries are using it as their excuse. And these poor EM traders, and I was looking at a piece talking about how the biggest bond funds in the world have been splatted by Argentina and the withdrawal elsewhere as well. But as we mentioned last week, the US will make monetary policy for who? For the WTO, for the IMF, for the emerging market. They'll make it for the US. They don't give an absolute jot about anyone else. The monetary policy is going to be made for an economy that has not only got earnings at 23.5% higher in the second quarter year on year, but is also growing at a stonking great 4.2% in the last set of figures that we had for second quarter last week as well. So the US will continue making policy for the US. And just one more teeny little point. Detention, we haven't even got Italy on there. Italy is a 2.3 trillion euro economy. It's got over a quarter of its funding it still needs to find money for in the last couple of months of the year, which tend to be slower as well. And we've just had a deputy prime minister, one of the most powerful men, Di Maio, in Italy saying, yeah, we're going to make, we don't care about the ratings agencies, we're actually going to have worry about the Italians. Well, that's fine, but someone's got to finance this debt.
The interesting thing at the moment is there is a growing consensus, it seems to me, that we are being set up here for a melt-up to the end of the year. And the Jackson Hole meeting was very instructive, even though we didn't see Mr. Draghi there and we didn't see Mr. Kuroda there. The messages that were coming out of the US representatives was that we're not in any hurry to lift interest rates too quickly. So taking on board your point, this is monetary policy for the United States. This is also a monetary policy that will not necessarily be devastating for other parts of the world. The issue, I think, that links all of these stories is the dollar and ultimately what happens to the dollar here. We know President Trump doesn't want the dollar too strong, and I suspect that the Federal Reserve doesn't want to see it too strong either, which means that ultimately we could continue to grind higher for US markets. We may be indifferent on commodities, but it may not be that big buying opportunity that everybody's been looking for. Gold tantalizingly keeps dropping a little bit, but it doesn't get cheap enough to really excite bulls to step in and start buying it. And I fear that that may be what happens continually here with the emerging markets as well, unless we have one of those cataclysmic moments where the shoe ultimately really drops here and one of these governments does something daft.
Just touching on a slightly deeper point too, are the political ramifications. I mean, we have seen very strong policies that have come forward in the last couple of years after what we've had through the financial cycle where people felt left out. And you mentioned Italy. Well, let's just look at the example of Argentina. They had a crisis and you saw Macri effectively, well, his first economic policy was to scrap some of the export taxes on grain to try and bring the farmers on board. And the market sort of stepped back and said, what's that going to do to the fiscal position of Argentina? Fast forward a couple of years and here you've got a man looking to drop that key policy today. So let that be a message for Italy.
Sure.
If you bring about populist policies and you just say forget about the fiscal side of this point, well, I'm sorry, the bond vigilantes come out, the market comes back and reminds you why you can't pursue policies that don't add up.
But how pathetic are these bond traders sometimes? There you go, I said it. You guys, 1 minute, you haven't even seen the results of Macri's policies and you can't jump over yourselves enough to buy a coupon of 7.125% on a 100-year paper on a country that defaults every 20 years, that has inflation at double digit over a sustained period over its entire lifetime. But 1 minute, without seeing the results of Macri's strategy, you can't jump over yourselves enough to buy that with that pathetically low coupon for 100 years. Next minute, as Karen says, you've become vigilantes. Really?